Hey everyone, welcome back. In this video, I'm going to be talking about the ICT First Presented Fair Value Gap. In this lecture, I'm going to answer a question that was asked in the comment section with the video I made on the new week opening gap. And I'm going to make some clarifications on how you can use the first presented fair value gap. So the first presented fair value gap is the first fair value gap formed within 30-minute window before an ICT Q zone begins, except for the New York Q zone, where it is the first fair value gap formed 30 minutes after the New York Q zone. All right, so we have to know that the first presented fair value gap is based on time. It is time based. And the time outline here only applies to the Forex market. And then here applies to the indices. That's the NASDAQ, S&P, and the Dow Jones. So for the Asian Q zone, the first presented fair value gap is found within 7:30 p.m. to 8 p.m. Now the time zones here are in Eastern Standard Time. Then for London, it is 1:30 a.m. to 2 a.m. New York is 7:30 a.m. to 8 a.m. We all know that Asian Q zone starts 8 p.m. London Q zone starts 2 a.m. and then New York starts 7 a.m. Some people use 8 a.m. as New York Q zone, but I use 7 a.m. as my New York Q zone. But the standard, which is the ICT standard, the 7 a.m. is the ICT New York Q zone. That's when it begins. Then for your indices, that's the NASDAQ, it's within the 9:30, 10 a.m. time window. So it's very simple. Within this time window, the first fair value gap that you find is the first presented fair value gap. So here's an example of a chart showing the first presented fair value gap. This line here delineates the time window where you find the first presented fair value gap. Here's London, and then this is New York. For London, the first fair value gap found before the London Q zone, you can see this orange shaded area here. And then for New York, you can see this blue shaded area. And note how price reacted at this level. Back and forth, finding support, resistance, support, resistance. So now the first presented fair value gap also acts like the new week opening gap and also the new day opening gap. I'm going to be talking on the new day opening gap very soon. Now, why is this fair value gap relevant and how can you use it? Let me explain. The first presented fair value gap is not just a zone, it's a footprint of early smart money intent within a time-controlled environment. All right. The first fair value gap is a tool used to read price delivery, measure the strength of displacement, and anticipate market direction. It serves as a confluence factor and confirmation point when aligned with liquidity and structure. Now, to sum up all these jargons, in summary, you use the first presented fair value gap as a confluence, one, two, as a confirmatory tool. Note that it cannot be used without context. You don't just want to go to the chart and look for the first presented fair value gap and see price finding support, then you buy, or see price finding resistance, then you sell. No, it has to be used with context. Now I'm going to be explaining how you can use it as a confluence and also as a confirmation in a chart. Let's go. So here's the Euro USD. We're going to study 1 week data of this pair in order to understand how to use the first presented fair value gap. All right, so here's Tuesday. Remember, we want to find the first presented fair value gap within a time window. And for London session, you want to find it within the 1:30 a.m. and then 2:30 a.m. All right. If you look closely, I delineated this time window with this line here. We can see here and here. The first presented fair value gap was this here. So why did I not choose this? Why did I choose this? One error we usually make with the first presented fair value gap is that we use the fair value gaps that are too small. Any fair value gap that is not greater than 1 pip is irrelevant. All right. Now, if you look closely here, if I should draw these lines here, this low and this high, you will see that the difference is just 3 pipettes, which is not up to 1 pip, making it irrelevant. Now, I want you to know that if the gap is too small, the more likely it will be irrelevant to price. All right. So instead of using this or this, if I should also use this, you will see that you notice that the gap is not up to 1 pip. All right. So this is the gap we will be using. The second question you may have in mind is, why did I put this line here and not here? Okay, because a fair value gap consists of three candles and is the space or the gap between the first and the third candle. All right, so we have 1, 2, 3. So the gap between the first and the third candle forms what? Fair value gap. This is what we call sell side imbalance, buy side inefficiency. Okay, but if you look closely, you will see that we have what? A volume imbalance. So when you have a volume imbalance paired together with a fair value gap, you want to combine the two. So this is our fair value gap. Being the first presented fair value gap greater than 1 pips, it become what? The first presented fair value gap. All right. Now, one of the things we need to understand first with the fair value gap, we can use it to determine bias and strength. Remember I said confirmation and confidence. All right. So we can use it to confirm bias. Now, once we've predetermined price direction, we want to see price leave the first presented fair value gap in that direction. So we're using it as a confirmatory tool. If price will be bullish, we don't want to see price go below it. We want to see price go above it and continue to go in that direction. And here we can see how price created this first presented fair value gap. Then at London session, you can see how price broke through it, closed above it, breaking this high. That's a break of structure, returned, found support, return again, found support, and then rallied. Okay, let's look at the New York. Again, we can see that we have what? A fair value gap. If I take this line out, this is a fair value gap. But this fair value gap is not greater than 1 pips. All right, so it's irrelevant. We don't use it. Then the second thing I also want to say is that if the second candle, that is the candle where the inefficiency is found, because we have, this is 1, 2, 3. So this second candle here cannot be 730. The least it can be is 731. Okay, well, I assume that if this is 730, all right, let's say this candle forms at 730. This will not be our first presented fair value gap. We'll use this here. But we can see that here is not 730, this is 730. Okay. So the same for the London. If the middle candle, all right, that's the candle that forms the inefficiency, is formed at 130, that will not be used as the first presented fair value gap. I think my network just got bad. Let's just go back to what we're talking about. Where were we? So yeah, this is where we are. This is Tuesday. So you can see how price found support here. Look at this reaction. All right. And then never returned back to it. It left it and started going higher. All right. So let me show you another example again so that we can understand this concept I'm trying to explain. Already you can see how price rallied away from it. We want to see price run away from it. This will give us context that price is most likely to trend higher in that direction. Okay. So let's look at another example here. So this is Wednesday. Now, if you look closely, you would see that we have multiple fair value gaps here. We have this one and this one, but I did not consider this fair value gaps. Why? Because they're not more than a pip. They are insignificant. Now, the reason why it's looking large is because I expanded the chart. If I bring it to the normal size, you see how very small. This is 1 minute chart, guys. This is 1 minute time frame. So this fair value gap is quite insignificant because of how small it is. All right. Now you can see how price reacted here, found resistance, broke above, came back, found support. You see this back and forth, back and forth, back and forth. When you keep seeing price going back and forth, it also serves as support and resistance and as well serves as magnet. So when you see price going back and forth, you see, extending it back into New York, you can see how price kept going back and forth and the market did not what? Trend. Now, once we see this, is a telltale sign that price is most likely to consolidate, especially for that session. From my experience, the difference between the first presented fair value gap and the New York opening gap is based on time range. The New Week opening gap has a larger time range, meaning that previous weekly open gap can affect the next week. But the first presented fair value gap has more influence per session. All right. So now, how can we now use this to tell if price is going to trend or consolidate based on time distance? If price within the ICT kill zone keeps going back and forth, it's kind of like a telltale sign that price might not likely trend in that session. Okay. What we want to see is as soon as price found support, we want to see price leave it immediately in that predetermined direction. Now, when we go to New York, you can see this is New York. First presented fair value gap. You can see our price kept going back and forth. Within this kill zone, it left it and never returned. And you can see our price fell lower. Okay, so within this kill zone, we are watching to see if price leaves the first presented fair value gap. But if it doesn't, like it kept going back and forth, you can see here, this is the London Q zone, it kept going. Now, after leaving it here, would have been anticipating price to keep going lower. But instead, what happened? It came back at this point. Not until New York session, you can see this New York Q zone time window. It left it. As soon as it breaks below it, it came back to find resistance, resistance, and then boom. It wasn't going back and forth. It wasn't going close above, close below, like we see here. You can see how price kept closing above, found support, close below, like that. It only broke through it once after all this noise, broke through it once, right? Came back, found resistance, fell, came back again, and then fell completely. Let's see another example. All right, so this is Thursday. We can see that we have multiple fair value gaps here, but this is the most significant fair value gap because why? It is greater than 1 pips. And you can see how price reacted. Let me expand it so that you can see clearly. You can see price going back and forth, but then left it before London Q zone was over. Okay, telling you that price is most likely to trend. And once it left it, it did not return. Okay, kept rallying higher. So we use this for strength. If price keeps gravitating back to it, it tells us that our price is most likely to remain in consolidation. Once we see price leave it, we don't want to see price return back to it or even go below it if we are bullish. And if we are bearish, we want to see price keep going lower and not to return back to it for that session. It doesn't need to keep going like that throughout the whole day and the next day. No, for that session, and it's more used by scalpers and day traders. Okay, so let's go to the New York, and you can see how New York kept going back and forth, not until when it broke above it and then kept going higher. Now you may be asking, how can I actually use this for trade setups? How can I take a trade with this? I'm going to explain that very shortly. Remember, the first example we saw was a Tuesday. This candle here is a Tuesday. If you look below, this candle here is a Tuesday. Now, overall in price, if you draw your fib from this high, that is, we want to know where we are in our daily range, from this high to this low. Remember, this is Tuesday. Let me just put an arrow there so we can know what we are studying. This is the day we want to study. This is Tuesday. Now you can see that Tuesday price is currently below this 5% level. So this is a deep discount. We want to be buying at discount, selling at premium. So buying at this level is of a greater probability. Then look closely, you would see that we have what? An area of inefficiency. This is a fair value gap. Okay. This is an internal range liquidity. So price moves from internal range liquidity to external range liquidity. Now, if you draw your fib again from this low to this high, we will see again that we are at what? Discount. This fair value gap is at discount. So we expect price to retrace and run higher. Okay, so our bias is what? Bullish from the daily time frame. Second thing that also adds to our bias, if you look closely, you will see that Monday took sell side liquidity, like you can see here. So we don't expect price to start going lower again. Liquidity here has been taken, inefficiency here has been filled. And then one way to also measure the strength of this inefficiency, you can see that the bodies did not close outside this fair value gap. This fair value gap held these candles, just the wicks, of which I still refer to as mohawks. You can see price did not close below this fair value gap, telling you of how strong this fair value gap is most likely to hold price. Okay, so everything being said, we are what? Bullish. So if you get to the 4-hour time frame, nothing much to see, but then you can see we have a fair value gap here. This is the day we're studying. This is still Monday. From here, this is Tuesday. This candle here forms Tuesday. Okay, but we can still see an area of inefficiency here. Then the 1 hour time frame. Very good. So this is the Tuesday we are studying. Remember, this is our 75% level. Price is below 75% level here. So I think I can just take it out. Or let me just leave it. Let me just leave it in case for reference. Good. Now, on a Tuesday, if you note price rallied, and it didn't just rally, it formed what? An ICT order block, because we have what? A change of state of delivery here. If you look closely, we have consecutively down close candles, which have taken what? Sell side liquidity, and this candle closed above the open price of these down close candles. These consecutively down close candles. All right. Now, once price does that, this open price becomes our level for buying. If price should return back to this level, we want to be buying, and we can see this candle here returning back to this level. So we'll go down to the 15-minute time frame. If you look closely, you can see how price, as it was returning back to this price, it was feeling an area of inefficiency, and also finding support where at this 15-minute order block, which is also another change in state of delivery. So we have multiple confluences telling us that price is going to rally. Now, we don't have to get confused with the process I'm going through. You just want to use your system or whatever works for you. I personally, I use either the 1 hour institutional level or the 15-minute institutional level, and I go straight down to the entry time frame, which is the 1 minute time frame or 3 minute time frame to take a trade. Now, what do I mean by institutional level? Institutional level consists of the ICT order block, ICT favor the gap, ICT breaker blocks, and so on. So you can see we've identified the ICT order block in the 1 hour time frame and the 15-minute time frame. So whichever you want to use, if you use this, you're still good. If you use the 15-minute order block, you're still good. But if you look at the 15-minute order block, you can see we have what? An area of inefficiency, which is a high probability order block. So let's go down to the 1 minute time frame where we have our first presented fair value gap. So I'll scroll down to Tuesday quickly. Beautiful. Remember, this first line here is our 1 hour order block, and then this line here is our 15-minute order block. So price retraced down to the 1 hour order block and the same time to the 15-minute order block. So whichever one you choose, and you will note that price is above the first presented fair value gap and has closed above it as well. In returning back to our order block in the 1 hour 15-minute time frame, it was as well finding support where at the first presented fair value gap. So you can be entering here with your stop just below or below the swing low. You want to also be careful because price can wick through it and may not close below it and still go higher. So one of the things I need to do is I also want to find a change of state of delivery in the smaller time frame. So if you look closely, we'll see that we have another change of state of delivery here. So this is the 1 minute time frame. We have what? Consecutive down close candles. Now you want to be working with consecutive down close candle. It has to be a single candle or consecutive candles. Just imagine we have an up close candle here, and we have this consecutive down close candle. This will be where we will be looking at for a close above the price. If price should close above this level, we have a change of delivery. But we have this candles here, this series of candles here. So all we are doing is waiting for price to close above the open, and we have that here. Now, once price does that, we're entering with this candle, which is at 3:49 a.m. for a buy. And you can see that's what happened. Now, if we are not used to the change state of delivery, we can use what we call the inversion fair value gap. If you look closely, we have this fair value gap here. Let me change the color to red. If I pull it out, this candle here closed above this sell side imbalance, buy side inefficiency. Okay, you can see our price closed below it, and then return back to it. 1, 2, boom. Then we have our move. All right, so whichever you want to use. A second way we can also use this is what we call the market shift. All right, but we can't see it clearly here. If we go down to the, I think the 3 minute time frame. So remember I said I used the 1 minute and 3 minute time for my entries. So let's see what we can find here. Good. We have what? A market shift. So market broke high. We have a break of structure. In doing that, it left the fair value gap. So this fair value gap is what you would want to use to enter. So there are many entries you can use with this whole concept. All right. Now let's look at the last example, which is New York. Going down to the 1 hour time frame, you could see that price. Yeah, you can see our price retraced after breaking this high. Now, when we have a break of structure, it is expected that price is most likely to continue that direction. But remember I said, price moves from external range liquidity to internal range liquidity. And from internal range liquidity, price moves toward external range liquidity. So we anticipate New York to be a continuation because we are still in a discount and deep discount like we know it. Remember I said, we move from external liquidity to internal liquidity and internal liquidity to external liquidity. And our external liquidity is this high. So this is our target, okay? But rather than aiming for just this high, we can aim for previous daily high. I hope this is not a mod. So this high is our drawn liquidity, and you can see we hit it on Wednesday. So we are still bullish even after the London session. Okay, so New York, you can see our price formed a continuation, filling this area of inefficiency. Okay, so now how can we use this together with the first presented fair value gap? And as well, how can we use the first presented fair value gap to help us know that this trade is most likely to continue going higher? Here is our 1 hour fair value gap. I'll outline it here. I think I should make it blue. So going down to the 15-minute time frame. So here's our 1 hour fair value gap. And then you can actually refine it to this point because this is our 15-minute fair value gap. So taking this away, one thing I want to explain to you guys is whenever I personally see multiple wicks like this, I use the bodies to read price. The wick does the damage, the bodies tell the story. Okay, so this candle here will become our ICT bullish order block. So I'm going to outline from the open price and wait for price to close above it, because you would see that these candles here, they are consecutive down close candles. But if you ignore the wicks, you'll see that this is the lowest down close candle we can find here. This here. Okay, usually you want to use long wicks like this as fair value gap. You want to regard them as fair value gaps. Now, this candle here closed above the open price of this down close candle, which confirms what our change in state of delivery. What we want to do is we want to wait for price to return back to this price level here and then find our buy. Okay, so we can see this happening here. Going down to the 1 minute time frame. My subscription has finished. I think I have to buy a new one. You can see how price returned, found support, and then rallied. See how it kept rallying higher. Okay. So now how can we use this for a trade? Remember, price is finding support where at 15-minute fair value gap and at the same time at the first presented fair value gap. This shows strength. You can see how price failed to close below this first presented fair value gap. This serves as a confirmation and also as a confluence, tells that price is most likely to continue going higher. So in this time frame, there's nothing much to see. But if we go to the 3-minute time frame, we can get our entry here. So remember, our first presented fair value gap was at this level was because we can't see it now because it's hidden. We can only see it in the 1 minute time frame. All right, so we have this consecutively down close candle finding support at this 15 minutes order block and also at the first presented fair value gap. So when you draw your line, because we have what a bullish order block, this candle here confirmed what our change in state of delivery. As soon as price came back down to find support, you want to be buying, and we have a good trade here. So I hope this was helpful. Please, if you enjoyed this video, give it a thumbs up, and I hope I actually answered your question. Manrique Sanchez, I hope I pronounced it well. If you're yet to subscribe to this channel and you want to get more from me, please do subscribe. See you guys next week.